Good afternoon. Welcome back, everybody. Welcome to our second panel for this afternoon's event. So we have discussed fair value, the theory, and now we're going to discuss fair value, the practice. There is a famous quote, sometimes attributed to the US baseball coach Yogi Berra, that in theory, practice and theory should be the same, but in practice, they're different. So we shall see. We shall see. We have an excellent panel to discuss this topic. I'm going to start by introducing our first speaker, who is Henk Oosterhout. Henk is head of international operations for Duff & Phelps, so one of the world's leading valuation and corporate finance organizations, also managing director for Duff & Phelps Amsterdam office. In his illustrious career, he's had senior roles with Standard & Poor's, also with PricewaterhouseCoopers. He's also made a prominent contribution to the academic world as assistant professor at the University of Tilburg and a visiting professor at the Kellogg School of Management at Northwestern University. So, Henk, could I invite you to give some opening remarks, please?
Well, first of all, let me thank EFRAG for giving me the challenge to talk about the practical side about fair value. And also the challenge brings me to my first small edit in the presentation, where I've said, on the basis of quite a long time of experience in measuring fair values, that, yes, it can be challenging, but instead of calling it challenges, in determining the value, I've put it more like considerations, just to look at a small nuance there. But let me take you to the practice and see indeed whether practice is any more different than theory. And also, I've taken the time and some analysis in order to show to you, what market value, what it is in today's markets, and how it deviates from what's in the books of these companies, on the basis of a set of 350 large European companies. So what I would like to discuss are 4 points. One is a little bit, the fair value history within IFRS. Of course, also, in their theory and practice are at least, on the contents page exactly the same, the relevance versus reliability discussion. I will also talk a bit about valuation methods used in practice, and thereby in particular also, we're looking to the IFRS 13, valuation leveling level 1, 2, and 3. And as I said, compare fair value with market prices. So a short history, just to take you a bit, where valuation methods in accounting, in fair value accounting in particular. Of course, in 2005, when IFRS was mandatory adopted in Europe, it particularly showed up the fair value concept in business combinations and in share-based payments. Before that, there was already some work to be done on impairment testing. I'll also come back to impairment testing in the presentation. Then in 2008, the fair value measurement statement, within FASB saw daylight, and later on the fair value measurement, under IFRS 13. And then in 18 coming up, also a very important one, the financial instruments in IFRS 9. So, and IAS 36, as I said, impairment of assets already relates to fair value, a recoverable amount discussion, value in use versus fair value less cost to sell, as already discussed. And that was also already an attempt to use fair value, in particular when it comes to impairment testing situations. So to begin with, the relevance versus reliability. From a practice point of view, the relevance item is relatively clear, I would say, in the sense that markets have gained, popularity. Markets have gained, a stronger role in decision making, and therefore the relevance item of prices of market values is clear. Another point, which of course is also very important, as mentioned before, is comparability. Comparability, I think, in 2 dimensions: comparability in between companies, but also comparability within the same company over time. An issue is sometimes forgotten, but also quite important. So that relevance is indeed, a key item, and relevance comes at a certain price in the sense that, of course, prices are completely objective and values are not. So if you take it that sharp, that black and white, then, of course, values as being subjective need further understanding, need further disclosure in particular on how these values are derived. And one thing is through the valuation method, but second is also, the relevant input parameters of those values. Useful information is what information do you give? What information do people require? What information are companies, enforced to provide? What are they willing to provide? Yeah, we already touched upon the issue adverse selection. I'll also come back to that later. But it's of course also important, how sophisticated the users are, because the moment that people, read information, and you have to understand people, the users have to read more and more information. The question is also, what type of format do you present it to them? We see a bit of a trend towards, let's say, a boilerplate type of information. The question is, how relevant is that? You see a bit the influence of both the economic side towards information plus the legal side. I mean, there's issues of, what language can I use and what not. So all these things, the sophistication of users also determine, the relevance of information. What's a very important topic, in particular when it comes to a valuation matter which has subjective elements in it, as I said before, is consistency and disclosure. So when we talk, on a daily basis with our clients on valuation methods, we always say, let's try to be as open and transparent as possible as to the input parameters that we're using as a starting point. So that is not only to do with, what's legally required, but also saying more than that, than just a sensitivity analysis or explain, as to what you are valuing and how you are valuing it. Consistency also means that when you have done a valuation 1 year ago and you do the valuation again 1 year later, talk a bit about the consistency between the two. So try to make what we always say the famous value bridge. What has happened according to expectation, what did not, and again, please explain as to what has happened. And that's already quite a difficult exercise, but also a tricky exercise, because it's sometimes very hard for people that, were behind the wheel in that year to tell, what they did was not really, what they like to achieve. But on the other hand, this is a world of uncertainty, so you have to deal with it and try to explain. Again, further encouragement on the preparers to disclose more information, to disclose better information could be good. And there is both a role, I think, for the standard setters and for the users of information. So here is a bit of an example. I hope most of you can read it, and otherwise, it is probably better readable in the overall deck that you will receive. What I've done here is, I have looked at the market capitalization of the 350 constituents of the S&P Euro 350 index. Then we talk about 9.3 trillion in value in euros. And I have also shown some examples of industries within that sector. You see that the average market cap is roughly around some 30 billion, a little bit less. And then you see also that in some industries, companies have a larger average scale than in other sectors. You see, for example, in the healthcare space and other spaces where you see that large investments are needed, where it's important to have a large economy of scale, that there you see the larger companies in there, up to the smaller companies, going towards the bottom end of that table. So you see 9.3 trillion of euros is quite a large amount of invested capital. So it does mean that, information from these companies is quite relevant for the users, for the people that also, provided this amount of capital. And then the next question comes up: if these are market prices, how does it work with the so-called market-to-book multiple? So how does this market cap compare to the book value of equity? And what you then see here is a clear picture that there's a huge excess of market value over book value. So the same sectors you see over there, and what's measured in the blue column is the blue, let's say, rows is, how large is the market-to-book ratio. And what's then measured in the green column is how much billions of euros are we then talking. A couple of observations that we made. First of all, this is just, one moment in time, right? So it's just, one market cap element. Of course, these things, influence or change on a daily basis. But you do see that, you know, the more intangible-driven companies have the larger market-to-book ratios. Companies like real estate, like utilities, energy companies have the lower market-to-book multiples. And also one particular striking thing is that the companies in financial services that have a market value below the book value, which could be an indicator that maybe IFRS 9 may bring larger impairments to these companies. It's just an overview, but just to show that when you start talking about fair value accounting, how relevant it is to compare, let's say, you know, a simple thing like the market cap of your company versus your book value. If you look at the total headroom is roughly 4.4 trillion euros. So that is the, let's say, all the green rows added up minus a little, but still 80 billion intrinsic shortness on the financial side. If you add them all up, it's 4.4 trillion, which is roughly 50% of your market cap, right? So if you truly want to explain as a preparer, you know, on, you know, what drives your market cap, there is still some information to be provided, some room to be gained in order to explain that, or in order to further elaborate on it, without, of course, trying to explain what you see. But there is, let's say, apparently more intangible-driven elements that drive your value to a large extent. Which valuation methods do we see in practice? You know, that's relatively straightforward, I should say, after, you know, so many years of experience already. That is, you know, of course, on the level one side, in particular on financial services, mining and minerals, oil and gas companies, see that used quite often. It's simply, you know, giving the prices. The level two, which is what we call the market approach, so it's more like comparing it with other, you know, similar assets and derive multiple-driven valuations there. And then, of course, level three, when you have no observable inputs, and then you have to rely on elements, you know, normally when using an income approach, discounted cash flow, whatever you call it, is the level three that where we see those approaches most often. What can you then say, right? I mean, there have been studies, for example, in the CPA journal, with, I should say, a bit of a US focus, but there you see that the proportion of fair value assets to total assets is increasing over time. You see that between 2008 and 2013, it grew from almost 19 to more than 20%, and even in the financial service side, it was increasing even more. Also within financial service, you see that there is some hesitance, you know, when it comes to the value of level 3 information on the FS side. According to this research study, only 68% of the fair value provided through level 3 is being reflected in market prices. So what does it all say? It says that, you know, disclosure can be better, should be better, and the big question is, you know, how to encourage users more, and also, you know, what data to provide. And another important element is always also here, what is the exact market participant view? What is it then that companies sometimes, you know, have disclosure, you know, maybe, you know, too minimal, or let's say not to a large extent as they should, because it is clear that, you know, the more transparent you are, that's through adverse selection, as Professor Bini already indicated as well, that, you know, investors know that minimal disclosure tells something about the quality, or maybe the lack of quality, and therefore that you know, providing good information and being transparent is very key. And it's also quite clear from, for example, you know, a publication of the CFA Institute on disclosure from July 13, that more disclosure will normally lead to a lower cost of capital. So what we see is that there is definitely, you know, a trend to provide more information, to think more in M2B ratios. Of course, it still can be much better. One typical example where these discussions currently get stronger and stronger is that more and more companies are falling back to the concept of return on invested capital. They like to be measured on return on invested capital, or they have management compensation linked to return on invested capital. And then always when the question comes is, you know, what is invested capital? then these companies start thinking about that's the average of the book value of my assets. And when you then ask a question, okay, if that's the measurement, how do you then benchmark the outcome? Because, you know, with a high M2B ratio, is your return on invested capital 3 times higher than your relevant discount rate, or 4 times higher? What is it? Good discussions which shows that, you know, people are thinking more and more invested capital and therefore need also more disclosure actions there. It's also important to be consistent, as I said, to be consistent over time by yourself. It's important to be consistent when it comes to, in particular, level 3, to explain what happened before, what's happening now. You may even think of comparison with the industry. You know, comparability is key. And the last element is, you know, can this disclosure also force companies more to say about what drives their ultimate large market-to-book ratios without, of course, saying anything about the relevance of the market price, but you would expect from a company with a market-to-book of, let's say, 6 or more, or a sector with 6 or more, that it tells you a bit more about their own, you know, internally generated intangibles. As difficult as they may be, as uncertain as they may be, but it is important to provide some information there. Then here, you know, why is it relevant? 2 other regressions, and there I'm a bit sorry for the small font. What I tried to do there is, on the one hand, measure goodwill and intangible as a percentage of total versus the market-to-book ratio. And there, of course, not surprising, the larger the market-to-book ratio becomes, the more you also see goodwill and intangibles showing up. That's, of course, because those companies are in intangible-intensive sectors, and therefore, when they do acquisitions, it's also very logical that they pay for goodwill and intangibles. And the second graph is, you know, the financing function, you know, how much of the goodwill and intangibles are being funded by debt. What I've done there is a graph between the market-to-book ratio and the amount of debt in the capital structure. And there you see that the larger the market-to-book ratio becomes, the less debt gets in there. But what you do see is that debt is providing funding for some goodwill and some intangibles. So conclusion is that fair value information is informative for investors. However, you know, try to be consistent and explain as much as possible when it comes to the underlying value drivers. Thank you.
Henk, thank you very much indeed. I think that sets the scene very nicely. We'll no doubt return to a number of the topics raised in your presentation. I was very interested to see the evidence that the market appears to be applying its own discounts to level 3 fair values. So whatever the reliability is of those measurements, the market appears to be treating them with a certain amount of skepticism. But let me introduce the rest of the panel, and I'll start over on my left with Tanguy de Hapio from BNP Paribas. So Tanguy spent his entire career to date with BNP, starting out as a quantitative analyst working on derivatives valuation, but he's currently the Chief Valuation Risk Officer for BNP. And under his many contributions to the world of accounting and valuation, he's been a member of the ISB Expert Advisory Panel, the Basel Committee Accounting Task Force, the IVSC, the AFME Working Group on the Prudent Value Valuation. So welcome, Tanguy. Turning to Roxana Damianov from ESMA. So Roxana is the team leader within the Investors and Issuers Department of ESMA. Her role covers the coordination of ESMA's activities on accounting, auditing, prospectuses, securitization, and credit rating agencies. That sounds like a big portfolio, but she still finds time to be the ESMA representative on the EFRAG board, the CEOB, the Accounting Regulatory Committee of the European Commission, and the IFRS Advisory Council. Daniele Solaroli is with PwC in Italy, where he leads corporate finance and valuation assignments for clients in Italy and beyond, specializing in the TMT sector, valuation for financial reporting purposes, but also M&A and tax-driven assignments, including impairment testing, purchase price allocation, intangibles valuation, and indeed derivatives valuation. So we have plenty of derivatives expertise on this panel. Stephen Cooper, until recently, was a board member of the ISB, where he served a 10-year term. I almost said sentence. I mean, never. A 10-year term on the ISB. Currently pursuing a portfolio career, although I understand the portfolio does include quite a lot of time on the golf course. well earned. And Henk, we have met already, so an excellent panel to debate fair value, the practice. But before we do, I just want to involve you, and we're going to bring up an audience polling question. So we have heard already from Antarctica that the IASB is in the midst of its post-implementation review of IFRS 13, fair value measurement. This standard didn't at all address the question of when fair value is used, but was intended to improve the consistency, practice, and transparency when fair value was already required to be used or can be used under IFRS standards. So, well, you've answered the question already, and we're up to 24 responses. Has IFRS 13 improved consistency in fair value estimation? I think that's a fairly resounding yes to some extent, which is a sort of resounding but slightly kind of ungenerous yes, really, to some extent. But we can consider that our feedback from today's event to the IASB's post-implementation review. So there we are, and I'm sure those of you who have contributed to the review in more detail can say to what extent it could have done an even better job, but overall I think we'll count that as positive. So, I said we'll see if theory and practice are the same or different, and I'm going to start out with a question for our panelists, the same question, or one of the questions we asked for the theory panel, but from a more practical perspective. So, from a practical perspective, what have we learned about fair value since the global financial crisis? And if I may, Tanguy, I'll start with you.
Okay, thank you. Okay, first, I'm only competent on financial instrument, and the good thing is the financial crisis. I mean, the crisis of 2008 was a financial instrument crisis, so I can say a little bit about that. First thing to realize is valuation is not an exact science. I'm saying that because I started in the bank as a quant, and I started in the early 90s, like many of my colleagues, learning Black-Scholes and all the theory about valuation, etc. And we treated it as a science. I mean, I'm a mathematician by academic background, so we took it as a science, and we thought that we had found the magic formula to value a bit of everything. That's where we realized that we shouldn't treat it as an exact science. Now, it has mathematics, it has some quantitative measure, so let's call it, I mean, soft science, like psychology, like sociology, etc. So let's take it as a soft science. It has a bit of element of art, and I would not disregard art because art is useful, and you need to have an artistic mind. Personally, I'm a musician, and it helps me a lot to put some background in it. So valuation needs to have all this artistic mind, etc. So that's the first thing to remember. Second thing is uncertainty. Any single valuation, apart from just looking at the BNP Paribas share price on the screen, which I see every day when I enter the building, so that's easy, it's written, and I know I can execute an order in the stock exchange at this price because it's a real market price. But apart from that, or the price of US dollar or things easy like that, most financial assets, and mainly derivative, which I know very well, have uncertainty in the valuation. And you might be aware, regulators, prudential regulators have developed the prudent valuation framework on an actual regulation under the CRR, so Article 105 of CRR on the regulation has been developed, which is meant to measure this uncertainty. It's a shame that it has been done through a regulatory framework as opposed to accounting valuation framework, etc. But that's probably a subject for the future. On IVSC, I do participate to the IVSC as well. I think we need to bring this uncertainty to the kind of more. It shouldn't be just a regulatory measure. It is something important to measure. So not only we need to measure the value, but we need to measure the uncertainty around the value, confidence interval. It's going to be bigger for level 3 asset than other. Third thing, controls. Something we knew, I mean, I've been dealing with market risk control, valuation control before the crisis, but it's obvious that any valuation needs to be controlled in some way. On internal control, Financial instruments are usually valued by the risk taker, so the traders, because they are the ones who have access to the market, most of the information. They need to be controlled independently. That's what the regulation imposes for any trading book. So independent control, internal control, that's my job. I mean, my colleague in market risk, valuation control, we do just that, independent control. Now, independent control internally needs to be challenged by external people, auditor, regulator, and we get challenged all the time by our regulator. BNP Paribas is regulated by the ECB, and we get ECB in-house challenging valuation process, not the actual formula, but the process, the governance, and everything. I have been writing myself policies, valuation control methodology policies, that's called, that's my most famous policy. That's what I do, writing policy about valuation control. That's
very good, thank you. Well, you referred a couple of times to the role of the regulator. So, Roxanne, I don't know if you're that kind of regulator, but perhaps I could turn to you to reflect on any particular practical learnings after the global financial crisis on fair value.
Yes, thank you. Probably just to make a distinction, because I think Tanguy was more referring to like the prudential regulators, and I'm more on the securities regulator side. And I'm very pleased that actually the accounting and the prudential are still kept separate, because we have some points which are different and needs to remain different. What I would learn from the financial crisis, I think definitely that was a challenge for the valuation of both financial and non-financial assets. And afterwards, we heard much more often talking about the procyclicality, about the risk of the mispricing of risk, about the disconnection between the short-termism and long-termism, and about the timeliness of impairment. I think from a pure technical perspective, that brought us thinking more conscious about why this danger of widening the gap between the valuation and the real economics of transaction. And this is probably what was the link that was needed to be made by the accounting standards, and I think to a certain extent the standard tried to solve that. It doesn't mean that it has all become perfect in the meantime. I think we still haven't. It was interesting to see in the presentation which started this panel to see that there are still probably areas where we see a bit of quite a lot of headroom, and we still expect to see some impairment to be recognized. We are not yet done with the job, I would probably say. And probably to complete the picture, bearing in mind that there is this, in a way, all actors in the market have a role to play. And when I'm saying this is because we blame the financial institution, they have a role, and then the regulators and so on. But in the end, I think it's a matter of behavior of all individuals, and there goes really to preparers, auditors, regulators, and ultimately investors, because investors also put discipline and they take from the fair value what is to be taken from the fair value. Then I think also our job, it's easier.
Thank you very much. And Henk, anything to add on post-financial crisis reflections?
Maybe just a little bit, right? I agree with, in particular, what several people have been saying, that it's a combination of art and science, right? I mean, it's not a matter of fully stepping away from the science. But what you see in particular since the financial crisis is that valuation is probably also more to be characterized as a kind of craftsmanship. So it takes some experience to get better in it. And you also see that, I think in the years after the financial crisis. If I draw a bit of a parallel between the impairment testing, which was already before the crisis, in there as well. If I see the company struggling with the concept of a pre-tax WACC, with what I also struggled, because a pre-tax WACC in finance didn't exist before the accountants invented it. So it shows that you really need to get experience, that you need, your examples, your basis for conclusions in order to get there, right? And that's also what you see probably in the years after the crisis happening.
Very good. And Stephen or Daniele, anything to add on this one?
I'm happy to add something, if I may. I think the most important thing we learned about fair value in the financial crisis is the importance of transparency. I think transparency breeds confidence, and I think confidence is good for stability and it's good for markets. So I think disclosure is key. I was interested that Tanguy mentioned about the measurement uncertainty disclosure. The ISB tried to introduce that in the fair value standard, but there was a lot of negative reaction from the banks in particular, saying that we shouldn't do it, and it didn't get there. So there's a kind of uncertainty through the sensitivity, but it's not really the full thing that was proposed initially.
When regulator came, they didn't give us a choice. So
the other thing I'd quite like to mention very briefly is the importance of fair value disclosures for assets that are not measured at fair value in the financial statements. And I think David mentioned this earlier, but having good quality fair value disclosures for the loan book, I think that was a big thing that was missing prior to at the time of the crisis. And I remember being in many meetings where it was completely apparent that very little effort was being made in measuring those fair values. It was kind of assumed that the impairment test did it, and we'll just put down book value equal to fair value. And I think companies and auditors really didn't do a very good job at the time of the crisis. I really hope now that the quality of the fair value information on the loan book has seen a big improvement. I'm not entirely confident it has, but I think that was an important lesson.
If I can link to
Please.
Stephen was saying, what I understand in my experience working in the financial crisis in valuation is that, for example, management preparing the financial statement are not willing at all, are scared about volatility. What is very, very important, I have a client of mine that, when the interest rate goes down and down and down, in order not to bring the discount rate in the impairment test, for example, too low, and not to have to make an impairment afterwards when the interest rate goes up again, it also widen the period of time to look at the interest rate. 2 years average. Backward looking for an evidence of what could be a sustainable interest rate in future. If you do this, you leave the valuation really not close to real markets, you know. So that's what I learned in my experience during the crisis.
Very good. So we're all somewhat older and somewhat wiser since the financial crisis, it sounds like. The next question I'll just throw open to any of the panel who would like to have a go at it. But one of the themes emerging from our first panel was that perhaps it's a little reductionist to be talking about whether fair value is a good thing or a bad thing. It depends on the circumstances. And of course, we do have a mixed measurement model as well as mixed measurement in the balance sheet. We have fair values through OCI as well as fair value through P&L, fair value in the footnotes, as Stephen points out. So any particular reflections on when you think fair value is more or less appropriate based on perhaps the characteristics of the asset or the business model or some other factors you'd like to mention? Any volunteers to go first on that one?
You know, I'm a proponent of fair value because that's my job, and I deal with derivatives, so there's no question about it. But when you look at some ALM thing, for example, you have demand deposit and you lend the deposit. You cannot put fair value because what you have is you match the cash flow. So you get money from your customer, you lend this money, and you get a kind of margin. So zero, you pay 0 interest rate, you lend at let's say 2%. So valuing the loan, which is financed by this deposit at fair value, wouldn't make any economic sense. Because what you need to value is a combination of your demand deposit and your loan. And what you need to value is the margin, so the future margin. So that's a case where it is absolutely justified not to fair value the loan, or you would have to fair value the demand deposit, but at a value which is different from the actual nominal value. And that's where the problem of fair value is. But everything else, most of everything else, can have fair value, except credit is a problem. Credit is a problem because the question is, if you have a loan to maturity, do you care about the fluctuation of the expected? I mean, not the expected. It's the market perception of credit. So the CDS rate, etc. Do you care about the way CDS rates moves, or do you care about what you may lose with a certain probability? And that's where I can agree that you'd better to have an expected loss model, and I prefer expected loss rather than incurred loss because at least you have some economic meaning. But valuing the whole loan portfolio with CDS rates would just be crazy and meaningless. So you have to be careful about what fair value means for assets that are not intended to be resold at any time. If you have an asset that needs to be resold, like equity, like forex position, then you need a value because one day you will have to sell and it will be market value. So you cannot avoid it. But for loan on credit, I can understand on officially BNP Paribas is in favor of the mixed model. And we will never put the loan at fair value for this reason.
Thank you. So business activities, how the asset is actually used in the business, how it will generate cash flows, and also the linkage to other items are important.
Yeah, the way they are linked together. Yeah.
Criteria. Other thoughts on the when question, or in what circumstances?
I think that fair value provides the most relevant information in many circumstances, and that it is very important that it's used in those circumstances. So a property portfolio, the investment portfolio of an insurance company, many of the securities held by banks. Anytime you have an equity investment because of the uncertainty and the fact that cost just doesn't really mean anything, the lack of contractual cash flows. And of course, not forgetting the measurement of many expenses. So share-based payments, pensions, not exactly fair value, but close to fair value. And I think it's really important that we accept fair value in those circumstances where it's important. I don't think measurement uncertainty should be a barrier to fair value. It should be then a necessity to give more explanations about fair value, but merely something being level 3 rather than level 2, I don't think should affect the importance of fair value. We shouldn't have part of an investment portfolio of an insurance company at cost and part at fair value just because part of it's at level 3 and there's greater measurement uncertainty. Of course, there are disadvantages to fair value as well, particularly for those business models where the evaluation much more reflects the flows of the business. So more of a commercial company, situations where it is more of an accruals, accounting type construct, focusing on the flows that then provides that relevant information. So inevitably, we end up with a mixed measurement model, which creates all of the challenges that we know a lot about.
Many thanks. Other reflections, or we can move on?
Oh, well, I think that probably we had the right balance if we look holistically between financial institution and non-financial institution, where they have cases where fair value is required, or in other cases where it's up to the choice of the company. But it's definitely it's better reflecting the reality in which we are living, the financial innovation which is happening in the financial market, so it's definitely a good thing. The advantage is that having that information gives actually the right answer to what is the level of risk to which an investor is exposed. Now, I think what is also good, in addition to have this mixed model, is the fact that there is a comprehensive model and having these level 1, 2, and 3, and I don't know if in the future there will be other developments, but that gives also the possibility of tailoring depending on the situation which exists in the market. So definitely good things. The downside of that, and we saw it also in the presentation, like level 3 measures are considered with a different level of reliability by the users, and I think that it's the level of judgment which is implied there might not always help.
Okay. Well, a perfect segue into the next question. There have been a lot of references in this panel and the previous one on measurement uncertainty, level 3, what do you do in the absence of active markets, and I guess IFRS 13 seeks to partly address these concerns through additional disclosure. I know that ESMA has done a lot of work looking at the usefulness and the quality of disclosures about fair value. So, Roxana, any reflections on the information financial statements should be providing about fair value?
Yes, and well, when you look to the financial statements, I think, first of all, just to lower a little bit the expectation, I think it's impossible for financial statements to really depict the complexity of the business of companies. Nevertheless, they are the best tool companies they have to communicate, and it should remain a good tool, even though there are some debates around that lately. But probably what we as regulator want to see, and what we encourage always, is to have high quality of disclosure that put the fair value in the right context. And probably the first thing to bear in mind when we looked actually to the disclosures which are made, I think there was, I know it's like a new concept, but actually the standards are written with an objective for disclosure. And if any preparer is using that as an overarching principle, and is not forgetting to look back to that, have I achieved the objective of the standard, then I think things are going into the right direction. Our study, which was done and published this year, I think showed there was quite a good level of compliance with IFRS 13. It's probably one of the rare messages coming from the regulator, but I think there are a lot of positive things coming out there. Nevertheless, it's always a bit of a learning curve, and probably three areas which I would like to mention were, well, level 3, which I already alluded to, and particularly the fact that level 3 is particularly important when assets are in stress, and probably disclosures which are to be done in that context are very relevant for the investors, because there is nothing else at which they can make a better assessment. Then sensitivity analysis, and I think there are some good students probably in the banks. I think they went they did quite a lot of progress into that area, and we see much more. Okay, quantitative analysis, it's not always maybe easy to be done, but I think it's there. But it's an area which we are encouraging also other companies to do better. And then probably the last point, I think, would be really to make the connection between what is there in terms of fair value, in terms of maybe valuation adjustment sometimes, with the more overall context in which, of the business in which the companies are going.
Many thanks. And Steve, you've referred to the disclosure of fair value. Any further reflections on that, or disclosures about fair value?
I mentioned the measurement uncertainty disclosures. I think, and Roxana mentioned about some of the good quality disclosures that you do see. I'm encouraged by the way that many companies have approached this to try and bring the transparency that investors need. I think that it's important to have disclosures about the inputs and also the processes. I used to think that perhaps that wasn't necessary. I could go back many years. I felt that perhaps this was an area where there was an element of disclosure overload. I mean, do I as an investor really need to know whether it was a Black-Scholes model or a lattice model? Surely I can rely on the auditors and the regulators to effectively police these fair value measures so that I as a user can have confidence in them. But I'm afraid the crisis and my experience of the last 10 years has sort of shifted my opinion somewhat, and I do believe now that the disclosures about the inputs and the processes are important in order to give that confidence to investors. It's a challenging thing to do because, of course, of the complexity and the number of instruments, and it's not easy to get across the information to give that confidence, but I think it is important that the financial institutions in particular do their best in that area.
Yeah, thank you, Steve. Please go ahead, Tanguy.
Just one remark about disclosure. I think we need to distinguish between external disclosure, so for the public, for investors, and disclosure, I mean, for example, the disclosure we need to do for regulators, because we obviously disclose much more information to regulators, auditors, etc. I don't think banks will be willing to disclose every single thing to the public, because there's also secrets and all of that. Now, we disclose everything to our regulators. The fact the regulator can challenge and go to a big detail of information, for example, prudent value regulation impose a certain disclosure or to give a lot of information to the regulator, not to the public. I'm fine with that, because we need to be challenged by authorities. I don't think, the investor or the large public can know everything, because not everything can be disclosed. And I think they will be lost anyway. So I think we have to make a distinction between a full disclosure and a full audit to authority, who are there to reassure the public, on the fact we disclose less to the public.
Very good. Other comments, Daniele?
Yeah, I think that disclosure is very crucial, not only for the reader of the financial statement. That's with a full and comprehensive disclosure can understand how discretionary and subjective could be, in particular, a level 3 fair value estimate. But also for the valuation practitioner that can find in the notes, to be very practical, in the notes to the financial statement, important benchmark, for example, to figure out some important valuation input. If you think to the valuation, at the valuation of a brand, I don't remember who first mentioned this kind of valuation of this intangible asset. Royalty rate, for example, to apply to the revenues driven by that brand is a crucial element in the valuation. And in my experience, I have now more or less 70-year experience. I never seen in any notes to the financial statement the disclosure of what level of royalty rate they used to come up with a fair value. So disclosure is important, in my view, not only for the reader, but also for the practitioner in the valuation profession.
Very good. Well, as we've noted, the IFRS 13 post-implementation review is underway, and I think the ISB team is still digesting the feedback. I'll be discussing this at the ASAF meeting later this week, but of course feedback is mixed, as it always is, and we found EFRAG ran its own survey of the European community to provide our feedback to the ISB's process, and we found there was a little bit, I don't want to overgeneralise, but I'll generalise a bit if you'll bear with me, a little bit of a dilemma, a difference of views between the user community, which thought maybe these are good disclosures, we need more of them, and the preparer community, which argued that whilst they were useful in theory, in practice, given the volume of instruments that can be fair valued, it's very difficult to convey meaningful transparency, so why not reduce it or take it away? So we'll see where that one lands, but I'm hearing from this panel quite strong arguments for an appropriate degree of transparency around fair value. Okay, I'll go to another question which might overlap with the previous panel, but we'd like the practical perspectives from these panel members. So of course the use of fair value can result in volatility being displayed. One can debate whether that's economic volatility or accounting volatility. Probably it depends on the circumstances, but it can be volatility in profit or loss or OCI or equity, as the case may be. That could potentially have unintended consequences. What does that mean for financial reporting? Is that a problem? And Stephen, I'll turn to you if I may.
I think people should not be frightened of fair value and not be frightened of volatility, and sometimes I feel people are too frightened of it. I voted no to the question earlier about does fair value contribute to short-termism. I firmly believe it doesn't. If I'm an investor in a property real estate company, I may be a long-term investor. The real estate company itself may be a long-term investor in that real estate, but I firmly believe that the only relevant reporting of a property real estate company is fair value for the property portfolio. I hope that one day the ISB removes that cost option. I'll be sending in my comment letters if that ever comes up for comment. I don't think that cost is at all relevant in that situation, and I think updating the fair value, even if it's done quarterly, providing that up-to-date information about the value of the property portfolio is essential to support long-term investment because people aren't willing to make those long-term investments unless they're confident in the information they get, and the only relevant information in that case, in my view, is fair value. People, I think, exaggerate the problem of volatility. I don't think volatility is a problem for most investors. You see, everybody thinks that investors just focus on the bottom line, net income. Of course they don't. It's ridiculous to think that any sane investor would do that. They look at the components of the P&L and what's derived from the sort of flows and the revenues and the expenses, what derived from value changes, how the pension fund has done during the period, and each of those contribute to the performance of the business in very, very different ways, and adding them up into one net income number is crazy. If there's one improvement I'd make to financial reporting is delete the bottom line of the income statement, just not add it up. Just report the individual components, but not the total at the end of the day. Of course, you've got to differentiate between accounting and economic volatility. Yes, it is a problem when volatility purely arises as a result of accounting mismatches, so measuring one side of the balance sheet at fair value and the other side at cost. Inevitably, that's going to produce some difficult to interpret figures. We also have the problem of economic mismatches that can, or accounting mismatches that can come through the use of OCI. I've opposed the use of OCI for insurance all the way along. I still think it's a bad idea. Great that we have a current balance sheet, but you end up with accounting mismatches through OCI because you can choose when to sell the assets and you tend not to sell the liabilities, and therefore what goes through the P&L doesn't have a great deal of meaning. We had to go there because, my view, it was because of the V word, the volatility word. People are afraid of the volatility. And I think if only we could get to a world where people were less afraid of volatility, we'd be far better off in financial reporting.
Very robust view there. So, Tanguy, I'll turn to you. Same view, different view?
I will take a very practical example because we do practical things here. Let's take a very basic interest rate swap, 10-year euro, because we are in Brussels, so it has to be euro, fixed floating. Okay, now, there's different sources of volatility of these swaps. That's the only thing I have. If interest rates move, the value of the swap is going to move. That's a useful volatility to know, because if I want to unwind the swap, I'm going to be exposed to this fluctuation of value. Or if I don't want to unwind, but I'm going to have this fixed minus floating cash flow, this is going to be volatile cash flow. So my string of income is going to be very volatile. The volatility of fair value reflects an actual volatility. And that's why I'm not going to keep this swap just alone, because it's too volatile. Now, that's first source. Second source, let's say this swap is uncollateralized. Let's consider for 1 second I've hedged this swap with another swap, with an exchange, with LCH, for example. So I have no market risk anymore, I have a counterparty risk. It's uncollateralized, I have counterparty risk. Now, the counterparty risk estimate might be volatile, and that's the famous CVA. The question is, how useful is this volatility? I'm not going to do anything about it. Probably I'm not going to hedge it. I'm not going to do CDS in front of this swap. I'm going to keep it in my portfolio like a loan, because it's a counterparty risk exposure is like a loan book, it's a credit risk exposure. Is it useful that it's volatile with the CDS, and we know the CDS is very speculative? I'm not so sure. Should have I an expected loss model for my counterparty risk? Okay, that's very controversial because we are introducing a kind of expected loss model in a fair value instrument, and it's a derivative, but I would say, why not? Because my counterparty risk is of a different nature than my market risk. So that's the second element. Third element, DVA, own credit. Nobody cares about the fluctuation of the value because of own credit. And that's misleading, that doesn't tell anything, and that shouldn't exist. That's my view. So you have some component of fair value, which are officially in fair value under IFRS 13, which have a volatility, which means nothing, and usually you disclose it somewhere else, and you just forget about it, because you make sure that it's disclosed in a part of your financial report that nobody is going to read.
Okay. So in summary, it depends on the volatility and whether it's real.
What I was saying, it depends. So the market risk volatility, interest rate volatility was absolutely crucial to disclose. The counterparty risk are mixed, and the own credit is misleading.
Very good, thank you. Anything to add, Roxana, perhaps? Or?
Yeah, I was thinking probably a bit more like looking from the market's perspective, because you say does use of fair value has unintended consequences. I think there are probably debates where in which cases it's more useful and in which aren't, but I don't think that fair values are driving in volatility. I think whether you use a different model, your volatility exists in the market because of other factors, and you know there are lots of other different elements impacting the price. So I wouldn't see now. I wouldn't say that fair value is guilty for volatility.
Okay, thank you. Well, I think it's time to turn to you, the audience. So perhaps you could bring up the Slido questions. I've got no idea what you've been asking and liking. Okay. Do you really think that financial accounts should explain the stock market valuation? Well, I don't want to volunteer anybody, but I'll naturally just look to Henk, given that you commented on this book-to-market value and its widening extent.
Not a surprising question. So it's not the case that I put a kind of a statement in there that financial accounts should explain stock market valuations, because stock market valuations are driven by supply and demand for the individual securities. What I did say is that the relevance principle, that when you see stock markets, you know, when you see an equity being priced, you know, at a much higher value than book value, that it deserves further explanation without trying to quantify it. That's probably the best way to put it. So it requires more disclosure. It means that you explain to the user of information that why you have those intangibles in-house and what you do and why that's reflected in for example, a high market book ratio, without an attempt, of course, to explain your stock market valuation. That's in between market participants.
Many thanks. I was looking at a study that commented on this so-called intangibles gap, and there have been many studies and different variations of the data reported, but it said that this is an issue for reporting, but it was a debatable point whether the best solution was to pursue putting more intangible assets on the balance sheet, or whether this was more for the realms of wider corporate reporting. Integrated reporting is one approach, but by no means the only one. So any particular reflections on the intangibles gap?
I might be reluctant to start trying to value intangibles and put them on the balance sheet. I know it would be good for your business, but but I don't think that's the way forward for intangible reporting. I think there are many other things that could be done to improve communication about intangibles, but not just fair valuing them.
Mm-hmm. You're more of a front end of the annual report person, perhaps.
Another point is that a financial statement at the end of the day is about transaction already occurred on the market. So if you are discussing here, if you want to improve the intangible asset valuation of what you bought for example, in a business combination, it's okay. But hopefully markets can also value and give value of intangible assets that are internally generated, like a brand, for example, that you can have fees with marketing expenses, but that you don't have both on the market. So the difference between the book value of a company and the market value, I think it's you can solve it. You should bring the financial statement to another level. Not only record the already occurred transaction, but also include what you have developed internally. So that's my view.
So a rather different perspective.
Yeah.
Which is why we bring a variety of panelists to have these alternative points of view. Can we bring the audience questions back up again? Let's see what else we've got. Okay. Well, actually, the next one, P times Q, we have that question lined up. You can't see that in the audience, but bear with us. We'll come on to it. How long will it be before there's a consistent approach to KVA in derivative valuation? That's probably rather a specialist taste, but perhaps Tanguy, you might. Yeah. Are we moving towards a consistent approach in KVA?
I'm part of the debate. I've been promoting the FVA, so now FVA is a reality. I'm not sure there is an appetite for KVA. I mean, FVA came at a time where everybody wanted to clean their book, so that's why they were an appetite to do something about it. KVA, there's less appetite, and I mean, the debate, we don't agree between us. All the academic debate, conference debate on that is, oh yes, we should take it into account when we price a deal, but we shouldn't put it in a fair value, etc. That's usually what we do. But yeah, KVA is a difficult debate. But we should first agree that FVA makes sense, and then you have the margin valuation adjustment, which I think makes sense, but which is difficult to calculate. I think we should clear that, and then KVA will come after.
Very good. So those of you who know what KVA is are much enlightened by that. Let's have one more question, perhaps a slightly less technical one. I think, to what extent should IFRS reflect market cap? We kind of touched on that. Okay, so for a level 3 valuation, can professional valuers add much to the company's view? Would any professional valuers like to comment on that question?
Yes and no, I would say. What professional valuers, of course, do and should do is to challenge management in order to further elaborate on their forecast, right? I mean, what brings you the forecast? Do all kinds of consistency views, you know, as to what market input do you have there? How does it compare to the competition? Why can you be different? So it is very important to come up with a challenging process there, and then to also try and put as much as possible there in the disclosure part of it. And this consistency already boils down to the consistency of the forecast itself. To give an example, if we come to a new client, right, we very often say, you know, when we're being provided with the, let's say, the budget or the strategic plan for the next 5 years, we say, is there also a plan available that you guys prepared 5 years ago, right? Just to see, you know, how forecasting capabilities were and how they have been, right? And already that question, it opens up, you know, quite a new dimension, which shows that, you know, in that discussion, you definitely can, you know, put more evidence to the table and more relevant inputs for the current valuation as well.
We should find, I mean, professional valuer we have. I mean, Bloomberg is valuing plenty of securities on their screen, which are marked to model. They are theoretical value. Okay, we can use it. Let's not forget that rating agency have allocated ratings. That's a professional mark to model methodology. They have allocated AAA to some assets which were not worth AAA at some stage. So that's a professional kind of valuation. And you have consensus price, which is not an external valuation, which is a collection of banks belonging to a club, giving their own opinion of what it's worth, and then we share the opinion, and we take the average, or we have the standard deviation. Okay, that's a kind of professional, external opinion. It's useful, but it's not the truth. I mean, it gives some ID, some alternative ID, but it's not the truth.
Not
because
the truth.
You will find how narrow the valuation of some very illiquid assets are. When you get 10 banks, they end up having the same price because they have an advantage to make their price as close as possible. And you know, you have this goal-seek function where you find out what price you need to quote so that you are close to the other, so that you all believe that it's, I mean, it creates, I would say, artificial certainty.
Fascinating, thank you. Right, let's move on. So we've talked about disclosures on IFRS 13, but IFRS 13 also has some measurement principles on the, it's not a valuation standard, but it does indicate some principles on which valuations should be based, including concepts like using the highest and best use of a financial asset and what to do in the absence of any observable market in a particular asset or liability being valued, for example. So any particular practical challenges that arise from estimating fair value on the basis of IFRS 13? I'll start with you, Daniele, if I may.
Yeah. So I have to say that as a valuation professional in PwC, I used to make 99% of valuation that are level 3 valuation. So I'm the poor guy that have to fight every day with this kind of valuation that are really judgmental, subjective, and discretionary from time to time. this is something that you cannot eliminate because uncertainty is inherent in the valuation work itself. If you don't have a price on the market, you have to look at, you have to mark to model the fair value to some valuation technique. Now to come to your question, is three main valuation techniques that can be applied to come up with a fair value measurement for financial reporting purposes. The first one is the income approach. Then we have the market approach and the cost approach. Okay, so the income approach is about to take things very, very simple, is discounting the expected cash flow from the use of the assets at an appropriate discount rate. Appropriate meaning that this discount rate that have to take into account both the time value of money and the inherent risk of the asset, and that's the problem. Let's start from the expected cash flow. Expected cash flow, as Hank said a minute before, is the most judgmental exercise that management can do. Here, you have to consider also that you have to start from the management case, and then you have to move to the market participant case and to the highest and best use case, because this is requested by the IFRS 13, for example. So you have to move from the management point of view that knows the company, knows what are the dynamics in the market, knows the company strengths and weaknesses, and produce this kind of projections. And you have to come in and say, okay, but now we have to move from your perspective to the market participant one. It's very tricky and very difficult and challenging to make this exercise together with management. But management has to be involved, of course, because it's inside the situation. And then we are talking about the business plan of the whole company or the whole group. But again, if you have to come up with a fair value of a brand or a customer relationship, that is even more tricky, you have to move from the whole projection for the company to the one specific for the intangible asset, for example, you have to value. And is, as you can imagine, very, very, again, judgmental. There are, of course, some indication in the valuation standards, but they cannot be so practical and specific from a day-by-day life application. Coming to the discount rate, just to don't put things too long, think to the specific risk that you have to consider when valuing a specific company or a specific intangible asset. First, you have to live with the WACC. We know very well that the WACC is not the best way, for example, or the cost of capital based on cap. The literature has now closed the point that it is not the best way to calculate, to estimate the cost of capital. But still, it's the standard, and you have to apply it in order to be standard, because at the end of the day, a fair value for financial reporting purposes has also to be in some sort standard in order to be comparable with other valuation in other financial statements. So this is again the balance between the reliance and the relevance of the valuation. And then you have to start from this judgmental measure that is the WACC, the weighted average cost of capital, and you have to add to this on top a specific risk. And this specific risk that should measure the risk that is specific in the intangible asset or in the company to execute in practice, in reality, the cash flow projected, it is something that is really, as Mario Bini mentioned before, Far West, because you don't have any principle or any practical guidance at all to do this. So again, it's another point that adds uncertainty and some sort of subjectivity to the valuation. Another point is the terminal value, because your company, of course, is a going concern, so you have to consider an indefinite period of time. For example, if you have to value a company, if you have to value an intangible asset, probably your intangible asset has a residual useful life that is longer than the period covered by the management projection, that is standard is 3 or 5 years. So you have to come up with some sort of, let's say, extrapolation of the future cash flow beyond the period covered by the business plan for finite life assets. And you have to come up with some sort of normalized cash flow for indefinite life intangible assets. So something that you can project indefinitely using the Gordon formula, I mean. So it is very, 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 again, subjective and judgmental. And the challenges are in every step of the valuation. Cash flows, terminal value, and discount rate. Okay. Then come to the second approach, that is the market approach. Market approach is about using the price you can see on the market. If you are lucky and the asset you have to value is as a quoted price in the market. But as I think we see in a minute, even the P times Q formula, if you have a quoted price for an investment in a quoted company, could need some adjustment to take into account, for example, the control premium or the liquidity discount or so on. So even when you think that is an easy job, P times Q, you have to consider things that are, again, subjective and judgmental. Because control premium or minority discount or illiquidity discount are not something that you can read in a book or in a guide. It is something that is based on the professional proficiency of the appraiser of the assets. If you don't have a quoted price, okay, you can look at multiples. So a quoted price of comparable companies or comparable transaction and make multiples. Multiples, it's very easy to understand, is if my comparable company trades 20 times their earnings, my company should be worth 20 times his earnings. But again, here the challenge is choosing the right panel of comparable company or comparable transaction. In some sector, this is very easy, let's say, or less judgmental. In other cases, it's very difficult. Let's move to the last valuation technique, that is the cost approach. The cost approach sounds easy because you should take the market participant point of view again and say, okay, what kind of cost I'm going to incur if I want to build a perfect copy of my asset. But I mean a perfect copy, not a new one, a completely new one. So you have to take into account also the real and the current condition of that assets that in the meantime can have become obsolete, for example, or some sort of obsolete. So the replacement cost new is something that is quite easy because you can look again at quoted prices for the same assets. But what is very tricky and challenging is to adjust this replacement cost new to take into account the obsolescence. So this is more or less the challenges of the of the valuation.
So are there some challenges? Just a few.
Just a few.
Apart from that, it's simple. Very good. Okay, time is moving on, so I'm going to bring up, and that was a very comprehensive answer for which I thank you. So I'll move on to the next audience polling question on the same theme of faithful representation, reliable measurement if you prefer, although those aren't supposed to be interchangeable terms, I know, but in the absence of active market, is it generally possible to faithfully represent the fair value? And we've got a unqualified yes, a partial yes, or a no. And actually, that's a pretty even three-horse race at the moment. with only for certain items poking its nose in front, but being rapidly caught up by the no. 29 responses. Keep those Slido buttons pressed. Well, should we announce the winners? Only for certain items, but actually a pretty evenly split set of views there. And still moving, of course, but we don't have all afternoon, so we'll call that mixed views. But yes or sometimes would be an overall majority if we add those up together. Any particular reactions, perhaps Henk, to that, or surprised by the results there after today's debate? No surprises. Probably views have always been split and they'll carry on being so. Okay. In that case, let's turn to the next batch of audience polling questions, please. Valuation and other comprehensive income, best friends or worst enemies, which you kind of might want to ponder what that question actually means. And we can take our pick among any of the questions on the screen, I'd suggest, given that they're fairly equal. It's another sort of four-way tie in the lead here. So goodwill, value in use, and fair value, are they so different? Well, perhaps someone with some experience on impairment testing would care to comment. Henk, maybe?
Yes, I can try. Of course, it's a relatively long history on goodwill impairment testing compared to some other IFRSs. The key thing with value in use is that you basically take the view of management in its current in the current stage of the assets, in the sense that not particularly it should be the same as the view that a market participant would have. So if the value in use is being determined on the management view and the asset is in the hands of the party that could maximize its value, then value in use has a reason to be, for example, higher than fair value less cost to sell, which could show up in the sense that therefore the company is creating value and therefore the company is not selling the business or the goodwill. I mean, that's probably my best answer there.
Mm-hmm. I don't think there is much difference. I think in spite of the fact of the different perspective, I think they essentially converge. Where there is a difference is the restrictions on how to measure value in use for the purpose of impairment testing. So the inability to take into account restructurings and the inability to focus upon sort of growth capital expenditure. I think that makes a big difference in circumstances, and my view would be to get rid of value in use. I think it's an inferior approach.
If I recall, the EFRAG discussion paper, still open for comment till the end of this year, called the Goodwill Impairment Test, Can It Be Improved? We actually also just float the idea of getting rid of one part of the test, but we suggest actually getting rid of fair value less cost to sell and keeping value in, and improve value in use.
I did notice that, Andrew.
Yeah, good. So it was deliberately provocative comment. But other comments on?
There was a question, can you put back?
Yes, let's bring those questions up again, please.
There was a question on prudential stuff that I wanted to cover.
Accounting, which to believe?
Accounting and prudential framework, which to believe. So, as I said, prudential framework has gone into the valuation sphere with the prudent value. So now you have fair value, you have prudent value. So you can understand prudent value to be a kind of higher confidence interval. So it's a more, I would say, it's a more stressed value. So it's a value under a more, I would say, stress scenario. But my belief is that it should measure the same thing. I mean, it should measure. It's a going concern valuation. It's not a value when you have to sell everything. So both are measuring the going concern value. It's a shame that it has been developed under different standards by different people. Thankfully, some of people who were involved in the fair value control, etc., were also in a group of people who have been dealing with prudent value. So, for example, myself, I've been dealing both with ISB panel on fair value, so IFRS 13, on the prudent value. So it puts some consistency. It's essential that the two concepts are totally consistent. And we should have all these people working together. It's a shame that different authorities have wanted to develop different things. And what is a shame is the reason prudent value regulation was developed is because it was one of the lead supervisor who was very keen on developing that, was believing that fair value was so imprecise, and so everybody was disagreeing on the fair value, that by putting a set of standards on prudent value, people would converge better. And I think there's more uncertainty in the estimation of prudent value than fair value at the end, because we are talking about confidence interval, so it's even more difficult to measure something which is a kind of lower side of the confidence interval. So the two should have been, thankfully in banks, the same people are dealing with fair value and prudent value control. And that's a good thing. But I would have liked that on the kind of authority side, they have worked together. And I hope, for example, IVSC mission will be to reconcile prudent value on fair value. That's a big mission.
I'd hope we can believe both.
Or not come with a third, or not come with a third value.
Naive.
Or not come with a different value.
I have to react to that, I think. Well, there are different missions for the different authorities, and securities regulators are pushing for transparency towards investors, and this is where we have sometimes the fight with a prudential regulator. On the other hand, on their defense of the prudential regulator, definitely they have a mission of financial stability, which is so important that for big financial institutions, they need to have additional information, and they have intervening powers which are higher than us. So which to believe, I think to the users, the only one available is the one which is from the accounting side, because the prudential reporting, it's not so much visible. Well, the part of it, but not all of it. Not all of it.
Right, good point. Thank you. Okay, well, time has just about caught up with us, and I'd like, again, to give our panelists a chance to make any closing remarks, share any closing messages with the audience. So I'll start on my right this time. Henk.
As a closing remark, maybe the following, that fair value is not only important because it's relevant, it's also saying something about the intrinsic aspects of the business. And what I think should be more and more get common is that you have the right disclosure about it, that you don't rely on, let's say, boilerplate type of information, but sometimes much more legally driven, I have the idea, but that you truly focus on the intrinsic capabilities of the firm, and that you talk about it and also try to talk about it in a consistent way, both over time, and therefore try to explain as to what you do in determining your fair value.
Thanks, Henk. Stephen.
My message would be what I said earlier: don't be afraid of fair values and don't be afraid of volatility. Stable earnings doesn't lead to financial stability. I think people make that big mistake. I think transparency and good quality reporting, which includes fair value where it's relevant, is what leads to financial stability. I think fair value is the most relevant measurement basis in many circumstances, but not all circumstances, and for many companies it'll be a minority of the assets, for other companies it'll be a majority of the assets. My last point is answering the question we didn't get a chance to answer, which was on there, which is, I think it should be P times Q.
Get that one in. I've still got time. Absolutely. Daniele.
Yeah. My final message is based on my professional experience with level 3 fair value. My final message is, don't ask level 3 fair value to be a proxy of the true value of an asset or a company, because it's a chimera. It's impossible. The judgmental side, the subjectivity side, the discretionary even side of this kind of valuation, it is something that cannot be, I think, eliminated. What I think you should ask to fair value and also to level 3 fair value is to be a standard value, in the sense that it should be really be based on the IFRS principle, on the best valuation practice, because it's about financial reporting. It's about the way the companies reports and accounts for their performances to the markets. And so he has to be comparable, as Hank said in his presentation, and to be consistent from year to year. So if you have to choose, of course it's a trade-off. Between, again, reliance and relevance. Fair value for financial reporting has to be both relevant and reliable. But if you have to choose, and only for financial, if you have to do a valuation for financial reporting purposes, and you have to make a choice, I think it is better to go for the reliance, to give a valuation that it is based on sound inputs and auditable inputs. Then try to give the best valuation of the real value, of the true value, of the intrinsic value of that asset.
Very good, thank you. Roxana.
So my messages would be, one, there is no trade-off between transparency and reliability, and that informative power of the fair value measurement is maximized by having a very good disclosure. So one doesn't compensate the other. If transparency is not enough, it cannot replace a good accounting and measurement. And also the other way around, if we have only the figure without having the relevant disclosure and the context around, but it's not enough.
Thank you. And Tanguy, feel free to give your view on P times Q.
Yeah, no, I mean, I don't agree. So that's a simple answer on the yeah, we have no time to develop that, but we can discuss it. I would like to link with the previous roundtable. Mauro Bini said, and I hope I do not misquote, that with better standard, we should have more reliable value for level 3 assets, something like that. He said that if we improve the standard, we will probably come to better, etc. There is a limit on how better we can be, because there is an intrinsic uncertainty, and this uncertainty exists. You are not going to fix the value to something, and I would advise not to try to have a kind of legal value. So legal value would be something that a lawyer, not a valuer, would write on saying, oh, I decide that this asset, difficult to value, should be valued this way, etc., and then you have the value. So I could decide that the value of an option, I put time value of the option to 0 because it's difficult to value, and I decide that every option should be marked at 0. I'm a clever trader, so I have a good idea. I'm going to sell plenty of options, get a premium, and mark my liability at 0. What I'm saying is, if you impose a value with a rule, you can abuse it. And there has been, let's not forget, 20 years ago, before the crisis, one bank in the UK, I live in London, so I can talk about it, one bank in the UK disappeared, NatWest disappeared and was bought by Royal Bank of Scotland, following a valuation issue, a serious valuation issue. At the time, it was 100 million pounds, something like that, not a big deal for now's things, but at the time was enough to get this bank, nearly bankrupt. What was it? The smile, famous volatility smile. At the time, the bank, so 97, had a policy that volatility should be constant, whatever the strike. That was the official valuation. And one trader was clever. He bought what we call a call spread, so different strike, and he managed to buy it at market price and record a profit. And he did that. So you shouldn't impose a value. You must first try to find out what the guy is doing, and try to figure out if he's doing that, there must be a reason. And then there must be an economic value behind it. Value is driven by economy. So maybe market is imperfect, or market might not exist, but there's always some economic behavior. So you cannot impose it. You need to be careful. And one given asset, a new asset, you will have to reinvestigate, and not rely on previous rule. You have to always investigate, always try to find out. So that's my message.
Perfect, thank you very much. For my closing remark, I'm going to borrow from you, Tanguy. So we're dealing clearly here with part science, part art, and if music has a role, we want the accountants and the valuers working in harmony. So that's my message. So thank you very much to our excellent panel. We express our appreciation.
Okay.
Thank you. And to close our event this afternoon, I'm going to invite Filippo Polli to the stage. Filippo is EFRAG's research director, and it was in fact Filippo's idea to actually organise this event. So Filippo, the floor is yours.
Good afternoon. I've been scribbling notes furiously on my paper in order to try to summarize the messages from today. I think first of all, I would like to explain maybe why we did organize this event. I think at EFRAG, basically, we deal with accounting issues, and I think there is more and more internal awareness and external expectation that accounting issues should not only be discussed within accountants, and that we have to understand a little bit the broader implications of accounting standards. And so we need to reach out not only to our, I would say, traditional constituencies of accountants, of users, of preparers, but also to people that are coming from different disciplines. And that's why we've been trying to build up our relationship with the academic world. And that's why, for instance, this event in order to bring in valuation experts and to understand a little bit better from them what are the challenges in terms of the theory and the practice of fair value. At EFRAG, we normally deal with the question of when to use fair value. And I think that we've heard today something that was quite interesting. We heard that fair value can bring relevant information because it's predictive in a situation of uncertainty. But exactly because it's a situation of uncertainty, there is a need to handle fair value with care. And so it is more useful when it is, in a way, less sure to use. And well, we didn't spend a lot of time on the OCI concept, which is the kind of accounting answers we've created in order to deal with the cases where fair value may be useful for balance sheet, but not for the profit and loss. That's a good answer. Sometimes maybe we've used it to reply to the wrong questions. I think there was a clearly consistent message this afternoon that fair value, we should not expect fair value to be something that is exact. It is not a science. It is an estimate. It is an estimate when it's level 3. Personally, sometimes I think that it is an estimate even when it's level 1. And so, therefore, since it's not exact and since it may be complex, understandability is quite key. It's not only about the number. It's about the process that the number is created with. So it's important to have good control. It's important to look at the inputs. Small changes in inputs can create huge differences. So it's important to look at the models, the sensitivity, the disclosures, which means that there is probably need to put more effort from those who prepare fair values in order to explain them, and for those that use fair value in order to understand them. And so really, we need this kind of to build up this expertise. And I think that I liked very much when Henk was referring to craftsmanship. That's a really beautiful word in order to understand how we use it. At the same time, I tend to agree with Stephen when he says we shouldn't be too afraid of fair value. And I think that sometimes we do this contrast between fair value and other measurement bases, like they were more certain in a way. But they are necessarily not. I mean, if I think about estimating provisions under IAS 37, fulfillment value, well, there are a lot of assumptions there. And even if you look at amortized cost, I mean, estimating the useful life of an asset, especially intangible, estimating the amortization pattern, the residual values, that's not necessarily easier than estimating a fair value. And maybe this is a good theme for next year event. So I think we had a lot of food for thought this afternoon from the different speakers. And personally, I think that when I have a lot of food, the drink can help. So I'm welcoming you to the drinks. And I want to thank all to the speakers and you all for attending. Thank you very much.